are using mobile phones more than ever, so much so that the small screen is unseating traditional marketing, offering a direct gateway to consumers. Affle India, a key player in connecting the marketer to the consumer in the modern advertising ecosystem, listed on the exchanges last month with a positive response. To tell us more about the progress since then, as a publicly traded company, joining us on the show right now is the Chairman and Managing Director of the company. He's Mr. Anuj Khanna Soham. Anuj, thanks very much for taking out the time. It's been a month since you've listed. You had a good response during the IPO period. What has it been like in this last 1 month? And also, can you talk a little bit more about how do you anticipate the company to grow come this year, considering that you have a track record of a CAGR growth of 32%?
Well, thank you for having me here. The post-listing sentiment within Affle has been at an all-time high in terms of levels of pride. And I'm talking about all Afflers, their families, the employees, the customers, partners, investors. I think the sentiment of a successful IPO is been very positive across the board, and I think that's adding to a halo effect on the otherwise anyways a fantastic business and a stellar historical track record, as you mentioned, of a CAGR of 32% and higher. So that's where we have been, and going forward into, let's say, building the company as a public company, having a 14 years track record of doing well as a private company has put fairly high yardstick. So when I look at the next 5 years of our organization, I'm seeing some very, very positive mega trends supporting us in terms of smartphone devices being used by consumers in a very, very heavy way, not only increasing in terms of number of transactions consumers are doing, but the average value of a transaction that the end consumer is doing from their phone is actually going up tremendously. And that's causing the advertisers and the marketers to shift disproportionately their marketing spends from traditional media to digital. And if I may say, digital in emerging markets, which is 80% of where Affle operates today, is actually just mobile. And so therefore, our outlook for, let's say, next 5 years is at least as good as how we have done in the last 5.
That would be 32%. But just tell me one thing. If the outlook is so positive, you would have probably seen initial trends of ad spends picking up. How much of a growth are you anticipating? What are the kind of growth in volumes in terms of clicks? You just spoke about all that. You touched upon it. Let's just get into details of that.
So I think I don't look at our business as a business of about impressions or clicks per se. I think the way I look at our business, especially for Affle India, is that we are driving conversions with consumers on the phone for the marketers. Whether it is a new user acquisition or a repeat user transaction or a conversion whereby the user looks at the ad on their phone within an app, but actually decides to, generate a footfall into a retail offline store and do a purchase or a conversion over there. So as a platform that's driving consumer conversions, the way we look at it is, what is the consumer uptake? What is the willingness to make payments from mobile phones? And if you look at all of those trends, they are actually set up very, very favorably. So the way to look at our business would be look at how the smartphone adoption is happening. What is the percentage of shoppers versus non-shoppers through the smartphone? So if India, let's say in the last financial year, we saw over 550 million smartphone devices connected, we only saw less than 15% being potential shoppers within the country. Going forward, I expect the number of smartphone users to grow disproportionately in the next 3 to 5 years, and more aggressively in terms of the number of shoppers that would grow. So hopefully the number of shoppers would move to 30% of the smartphone users to even 50% of the smartphone users in the next 3 to 5 years. So those are the consumer trends that we would like to track. I think impressions and clicks is very passé, and we have to look at it as an industry moving beyond that.
Okay, so let me ask you, what's your track record been in terms of new user conversion of the existing user, conversion offline of the new and existing user? How has the growth been?
So historically, what we've seen is, if you look at FY18 versus FY19, I think all this data was in our prospectus as well. We drove around 26 to 28 million conversions in India in FY18. We grew that to close to 40 million conversions that we drove in the last financial year, FY19. So the growth rate is in line with the kind of revenue growth rate that you've been seeing. It's a very clear, direct driver of our business. If the consumers are converting, the advertiser would definitely come on board and pay proportionately, if not better. So we are seeing a consistent growth trend there in terms of consumer conversions, as well as in terms of how the advertiser spend is translating into revenue for us.
Okay, got that. And how has that been going in terms of the ad spends and the increment there?
So in terms of the ad spend, the way you could look at it is that, previously the advertisers are spending a lot more on traditional media, and now they're shifting aggressively towards digital. And I mean, that shift has been slow. Running this company for 14 years, I've seen the market literally being born. And, in the last 5 years, we've seen at least 25% growth rate, at least from our customers, right, in terms of how their increasing spends are happening. So we take a slightly larger share of that in terms of delivering the 32% CAGR revenue growth because of our conversion focused metrics, where we are not so focused on impressions and clicks, but we are more focused on actually driving ROI for the advertiser. There's only one objective of an advertiser spending ad spends, is to drive their sales. And we measure that by saying that if we have delivered a qualified shopper to you, whether online or offline, then that's the way we charge our revenue. So we are seeing that we are disrupting not only digital but bringing mobile advertising in a very different way, not just doing impressions and clicks or a SaaS platform-based model, but more linking it to business outcomes. So if we drive a conversion, that's when you charge the advertiser, not for all the other metrics that have been traditionally followed by digital advertisers.
Okay. Anuj, the company's margins have improved significantly. Now, from FY16, when they were at 2.3%, to FY18, when they came to about 22.3%. Is that the trajectory that you're going to follow, or probably even maintain? Because this is a tough environment. And 22, 23%, is that something that you will be able to maintain?
So last year, our PAT was about 19% on a console basis, if I'm recording the numbers correctly. If you look at PAT as the guiding number, then we definitely aim to maintain that, because our business is unlike IT services companies, which are very manpower or OPEX heavy. In our case, we are a tech platform company. So when we grow our revenues, our headcount and our operating expense doesn't grow in line with that. So there are bottom line efficiencies in our business. So when we grow our revenues, we hope to drive much better growth on the bottom line overall. So it is fair to say that in tougher market conditions, we should at least maintain that kind of performance in terms of the financial bottom line metrics.
Just one last question. A bulk of your spend in proportion of the revenue goes on data and inventory cost, I think 50 to 60%. Is that something that you're looking to bring down or take it up? And the employee cost for you is a big part as well. You've managed to bring it down from 22% to 14%. Are you looking at probably squeezing that a little bit more?
So there, I would say we don't bring down the employee cost first and foremost. We actually consistently are growing our employee base. Of course, there is, appraisals on a normal basis. So that cost on absolute terms has been growing. But revenues have been growing faster than the OPEX. And therefore, as a percentage terms, you see that as a percentage of total revenue, that OPEX is lower. In terms of data and inventory cost, yes, I expect that to continue to be in that 55 to 60% range in the long term, because we don't see it as an expense, even though we expense it fully in our P&L. It's a necessary investment. Think of it as data and research, or research and data costs, because when I ended FY19, I ended FY19 for Affle with a huge amount of data asset, which has been fully expensed out in our P&L. But when we go into FY20 or even beyond each year, that data asset is an invaluable asset of the company driving the growth of the organization. So when you look at the financials and you see it as, it's a big expense item, it's actually a necessary investment for the continued growth of the business. And I wouldn't necessarily want to bring it down. It's the optimal level is 55 to 60%. Anything lesser is not a great sign, perhaps. Anything more is perhaps not optimal for the bottom line performance. So my view is that Affle will maintain that range for next several years to come.
All right. Anuj, it was great chatting with you. Thank you so very much, and best of luck for the upcoming quarter as well.
Thank you very much.
All right, so that's a very optimistic management there, continuing their charted growth course of about 32%. That's the stock 2.77% higher on a day like this. Moving on then, private insurers have made the most of the underpenetration in India, growing at a healthy double digit over the last few months. August through was an aberration of sorts when LIC outpaced all other players in the life insurance space. So what changed for the state-run insurer to outpace its private players? Joining us now to talk about it is Anshuman Deb. He's an analyst at ICICI Securities, who tracks the space very closely. Anshuman, thanks very much for taking out the time. What happened with regards to the divergence that we saw in the month of August, and LIC clearly outpacing the rest of its peers?
Yeah, we have actually seen a very consistent trend in the life insurance space of very healthy growth in new business premium as well as total APE. What we saw a little bit different in the month of August was a dip in the individual APE. Now that is largely driven by the ULIP business. As we all know that the private life insurers are a little bit ULIP heavy. So to that extent, that numbers kind of change depending on the business trend of the ULIPs. Life insurance on the other hand, Life Insurance Corporation of India on the other hand, does not have too much of ULIP. But to that extent, that volatility will always be there. Some months LIC would be higher, some months private life insurance would be higher. But broadly, the trend has remained the same. We have seen that the healthy double-digit growth in new business premium as well as total APE. But market sentiments will weigh upon how the ULIP business kind of tracks.
What about the overall, proprietary channel push and the distribution push that we've been seeing? Is that varying a lot between the likes of an LIC and some of the other listed players?
See, the listed players as well as overall trend in terms of life insurance has been towards increasing the protection share. The distribution of all major life insurance players are very strong in India, especially the guys who have a tie-up with large banks, and so has LIC. But LIC has a large agency force compared to others who have a more of a broadly diversified portfolio in terms of the large private life insurer players. So to that extent, distribution is pretty much steady, and it has only been improving over the last few years because private life insurers who were banca heavy have tried to make equal inroads in agency as well. So we have IPRU Life, HDFC Life and SBI Life who have broadly very strong both banca as well as agency, whereas LIC is significantly agency heavy. The mega trend in the sector remains that of product mix improvement, where we are moving more from ULIPs to protection, and that to that extent margins of all the life insurance players are increasing. Notwithstanding the monthly volatility, the overall quality of the business, if we are to track with the basis of margins, it might still be improving even in the month of August, because we don't know exactly what's the share of protection business. So that remains the major focal area as far as investors as well as the companies are concerned.
SBI Life, that one still continues to remain a leader among the private sector life insurers. Do you expect that to hold fort? I mean, it has a market share of I think about 13.8%. The APE business is strong. Second to that is ICICI Pru. How would you look at each of these individual names?
Right. So if you see over the last significant number of months, the overall trend has remained the same even in terms of individual order. So HDFC Life has been the leader in terms of total NBP growth as well as APE growth. Your SBI Life has been the leader in terms of number of policies, and whereas also a significant healthy growth in total business, whereas IPRU Life has a little bit lagged in terms of others. There is a lot of base effect which also comes into place, especially for IPRU Life, because they had a strong Q2 last year. However, the trend remains the same, and it also has to do with the particular strengths of the individual companies. So HDFC Life recently launched a guaranteed savings product, which has been a hit among consumers, and that will keep on pushing the volume. So I expect leadership to maintain for HDFC Life. In terms of SBI Life, they have a wide distribution, and the distribution strength of SBI Life remains a very important business driving point for the company, and that will also remain in focus. Whereas in iPro Life, we think it will recover over a period of time, and as market sentiments improve also. So broadly, we may expect the trend to remain the same. However, because of ULIPs, there might be a little bit volatility, because that share of the business will always be determined to some extent how the markets move.
All right. Just one last word from you with regards to the listed space. Do you have a pecking order in terms of which companies you like?
Yeah, so we have buy rating on all the companies based on the target price, and also our we like HDFC Life followed by SBI and iPro.
Okay, got that. Anshuman, just actually one last before we let you go on this particular topic, and going forward now as we dissect each of their portfolios, we can tell that probably for an ICICI Pru, their focus is more and dependence is more on HNIs, those big ticket ULIPs. So is that going to be a pain point for companies such as ICICI Pru, which have a larger share of big ticket accounts, to maintain those in the near term, or something which focuses more on the mass will do better?
Yeah, as you said, but the company the iPro does realize that diversification always helps, and to that extent they have started working since last year. So I do expect the benefits of that to trickle down to iPro also. To answer your question, yes, they had a large ticket size. They still continue to have a very large ticket size in ULIPs, and that but they are also conscious about that, and they have kind of introduced certain new products to address some different segments of people, and to that extent I think the things should improve from here on.
All right. Anshuman, thanks very much for joining us. Really appreciate you taking out the time. Remember, most of the listed players have been seeing very good gains in the recent past, even though while the overall market sentiment and the market mood may be depressed, these life insurance companies have done really well. Back to one of the big stories of the day, the government's latest measures for real estate is squarely on the affordable segment space. The promise of at least 10,000 crores from the government is definitely enthusing, but projects that have been stuck for more than 3 months may fail to make the cut. So should one wait for the fine print before celebrating? Let's ask Irfan Razack. He's the chairman and managing director at Prestige Group, who's joining us right now on the phone line from Bengaluru. Mr. Razack, thanks very much for taking out the time. Obviously, the consensus opinion is that this is definitely a step in the right direction, but it's just about scratching the surface with the entire set of issues that the real estate space is facing currently.
Yes, actually, we should look at this whole problem, this whole issue holistically, because basically now the issue of stalled project is something which is historical. And, at least the only, like you said, scratching the surface is the right thing. I would look at it as at least somebody is looking at us, and but the real diagnosis has to be done. And once the real diagnosis has to be done, the proper solutions also have to be found. And this just can't happen in just one policy measure. It's a holistic thing that needs to be looked at. It needs to, first thing is how to get these stalled projects off the ground, how to get them completed. Because the pain is on both sides. The pain is actually not on both sides, it's on all sides. The pain is with the developer, the pain is with the home buyer, the pain is with the government, because there's a lot of stress in the system. Now, if these issues are looked at very holistically, with an open mind, with a view to see that the problem gets solved, and clean up the historical issues, future, I believe, is still good, because you have the RERA in place. You have 70% of the money that comes from projects to be kept in an escrow account. So the question of liquidity and no money in the system will be that much more minimized, and the question of diverting funds is not there at all. So now the earlier issues need to be looked at seriously and see how it can be solved. to take the pain out of the industry. But the government also should realize that this industry provides a whole lot of jobs, and there are about hundreds of ancillary industries that are being supported by the activity of the real estate developers. And it's not that wantingly the real estate developers have got themselves into this problem. It's one problem or the other, a whole lot of policy changes that have happened over a period of time. So it's a combination of so many things that have happened. And now the only thing that can be done is how to get out of this. We need to have a debate. We need to find solutions. And the thing is, we need to find quick solutions to this. So the past pain can get out. The trust comes back into the market. The confidence comes back to the market. And then the home buyer is there free to buy what he wants. Because I'm telling you, there is, in an Indian context, there is demand. There is a need for housing. Only thing is, the confidence is not there. Okay. And that confidence needs to be brought back into the system, into the market.
Right.
And this can be done holistically with the several measures taken by developers, by the buyers, and by the government.
Right. Do you think, and that was going to be my next question, Mr. Razack, do you think the government has taken a balanced approach towards addressing both the developer grievances as well as, trying to aim towards, getting the demand going as well from the consumer's end?
No, the demand is there. There is pent-up demand. The only problem is there is a trust deficit. There is a deficit of confidence. This confidence needs to get back. And several policy changes have happened on several times. So this itself creates a lot of confusion. And that is where the whole problem is coming. I believe that if you look at things in a very holistic manner, find solutions. It's just not about liquidity. Yes, A, it's liquidity. B, it's taxation. C, it's pricing. And a whole lot of confused and very, very different parameters for different types of housing. Because if these things can be removed, there's clarity on all fronts. Believe you me, things will change drastically and rapidly.
All right. Post this announcement, Mr. Razack, is there any other clarity that the industry is seeking with regards to all of these announcements? And also the fact that, we've been hearing a lot as to, what's been done for the affordable housing space. But the bigger pressure, lies in the luxury segment, in the big ticket, flats that are getting stuck and not being able to be sold.
I think it's not about luxury or affordable or anything like that. Believe you me, it's a combination of all of these. Today in the Indian market, what is selling and what is the hour of the need is the affordable mid-segment. Now, if you look at just the other day, now this talks about a 10,000 crore fund. It's for projects which are not under NPA and projects which have not gone into NCLT. Now, the problem is, now, if are not under NPA, not under NCLT, then these projects really don't need any help. Yeah. It's the projects that have gone into NPA, the developers who are suffering because of various reasons of liquidity and cash flows which they can't service. This needs to be addressed separately and see how this can be supported as a one-time measure. To see that at least stuck projects, whatever projects, whether small, big, large, whichever size, these get completed once and for all. And then future is you have the mechanism. You didn't have the RERA in the past. Now you have the RERA. Even that will help you because a whole lot of money needs to get accumulated. 70% is a large amount from sales which needs to get accumulated.
Right. But the only question arises then how does a developer repay? Because if you're eligible to get some financing from the fund, the payback is on the back of sale of those units. And if the developer doesn't have that, then and what's the developer going to end up doing? All right. All right. I think, Mr. Razack, we're getting you on a slightly patchy line, but your point well taken. This is definitely a step in the right direction, but focus needs to be given to developers and projects that have already gone down the NPA and the NCLT route. and what happens thereabout. That's the management of Prestige Group, Mr. Irfan Razack. The stock's not doing a whole lot much, but the Nifty is above 11,000, still holding ground. Not a big cut, about 0.5% dip on this day. Bank Nifty has improved a bit. I think the opening it was down almost 1%. It's now at 27,926. With that, it's a wrap on this edition of Indian Open. Thank you so much for watching. All the market action carries forward on the F&O show.